You have been doing everything right your whole life. You worked hard, you saved, you planned, and now retirement is right around the corner. But here's what nobody is telling you. The IRS has been quietly waiting. And the moment you stop getting that paycheck, they show up with a whole new set of rules most people have never even heard of. Welcome to Smart Money and Retirement. I'm glad you're here today because what I'm about to share with you could save you thousands of dollars or cost you every single one of them if you ignore it. Stay with me because this one gets intense. Let's get into it. Number 1, and this one shocks almost everybody. Your Social Security benefits can be taxed. I know. You paid into that system your entire working life. You assumed it was yours. But the IRS doesn't see it that way. If your combined income, and that means your adjusted gross income plus half of your Social Security, crosses $25,000 as a single filer or $32,000 as a married couple, up to 85% of your benefits become taxable. Most retirees don't plan for this. They retire, start drawing benefits, and then their first tax season hits them like a freight train. Number 2, required minimum distributions. Once you hit age 73, the IRS does not let you just sit on your 401k or traditional IRA forever. They require you to start pulling money out every single year, whether you need it or not, and they tax every dollar of it as ordinary income. Miss a distribution? The penalty used to be 50%. They've softened it slightly, but it's still 25%. That is not a typo. 25% on top of income taxes for money you didn't even take out. Number 3, the tax torpedo. This one is a term most financial advisors whisper about, and most retirees never hear until it's too late. When your RMDs kick in, they can suddenly push you into a higher tax bracket, trigger taxation on your Social Security, and even affect your Medicare premiums all at the same time. It's a cascade. It hits you from 3 directions at once, and nobody sees it coming because everything looks fine on paper until the year it isn't. Number 4, Medicare IRMA surcharges. IRMA stands for Income-Related Monthly Adjustment Amount, and it means that if your income in retirement crosses certain thresholds, your Medicare Part B and Part D premiums go up significantly. And here's the brutal part. The IRS looks at your income from 2 years ago. So decisions you're making right now, today, could raise your Medicare costs in retirement before you even realize what happened. Number 5, the taxation of investment income. When you retire, you may think your capital gains are taxed at a nice low rate. And sometimes they are. But once you add up all your income sources, RMDs, Social Security, pension, dividends, your capital gains can start getting taxed at 15% or even 20%, plus the net investment income tax of 3.8% for higher earners. That bracket creep is real, and the IRS is counting on you not to notice. Number 6, state taxes on retirement income. The federal government is only half the story. Depending on where you live, your state may be taxing your pension, your IRA withdrawals, and yes, even your Social Security. Some states have zero income tax. Others will take a cut of everything. If you haven't thought seriously about where you plan to retire, this is the moment to start. Because moving to the wrong state could cost you the equivalent of years of careful saving. Number 7. Inherited IRA rules. If you're planning to leave an IRA to your children or grandchildren, the rules changed dramatically in 2019. Under the old stretch IRA rules, beneficiaries could spread distributions over their entire lifetime. Now, in most cases, non-spouse beneficiaries must empty the entire account within 10 years. That means a large account dumped into your child's income during their peak earning years, possibly taxed at the highest rate possible. This is one of the most devastating surprises in modern estate planning, and the IRS is not going to call and warn them. Number 8. Roth conversions and the window you may be closing. There is often a gap between when you retire and when Social Security and RMDs begin, sometimes 5 to 7 years where your income is unusually low. That window is arguably the single greatest tax planning opportunity of your lifetime. You can convert traditional IRA money to a Roth at a low tax rate, so all future growth comes out tax-free. But most people either don't know about this window or they wait too long and it slams shut on them. Number 9. The tax treatment of part-time work in retirement. A lot of retirees take on consulting work or part-time jobs to stay active and supplement income. That sounds harmless. But earned income in retirement can trigger self-employment taxes, push Social Security benefits into taxable territory, affect Medicare premiums, and bump you into a higher bracket for all your other income at the same time. It doesn't mean don't work. It means understand what working costs you before you assume it's pure upside. Number 10. Early retirement and the 10% penalty trap. If you retire before 59 and a half and start pulling from your retirement accounts, the IRS hits you with a 10% early withdrawal penalty on top of ordinary income tax. That can mean losing 30, 35, even 40 cents of every dollar you take out. There are exceptions. The rule of 55, 72T distributions. But they come with their own rules and their own traps. The point is that retiring early without understanding this is one of the fastest ways to dismantle a retirement you spent decades building. Here's what I want you to sit with for a moment. None of these things are secret. The IRS isn't hiding them, but they're not advertising them either. They're buried in tax code, in IRS publications, in fine print that most people never read because they assume their accountant or their HR department covered it. In most cases, nobody covered it. And by the time it surfaces, the money is already gone. This is exactly why smart money and retirement exists. Because the difference between a comfortable retirement and a stressful one often has nothing to do with how much you saved. It has everything to do with how much you kept. And keeping it means understanding the rules before the IRS enforces them on you. If this video opened your eyes even a little bit, do me a favor. Share it with someone you care about. A parent, a sibling, a friend who's 5 years from retirement and hasn't thought about any of this. You might be doing them the biggest financial favor of their life. And if you want to go deeper, I have videos on Roth conversion strategies, RMD planning, and how to use that pre-Social Security window the right way. They're right here on the channel. Go watch them, take notes, come back with questions. Because at Smart Money and Retirement, we don't just talk about building wealth, we talk about protecting it. And that conversation is just getting started.